P3 performance strategy, we're dealing with capital structure and specifically gearing. Manipulating gearing. The importance of the gearing ratio as a measure of the riskiness of the entity means that the classification of financial instruments as debt or equity is of great importance. Where an entity's gearing ratio is already high, it will probably wish to avoid issuing new financial instruments that fall into the debt category. A straightforward way of doing this is to issue uncontroversial equity in the form of ordinary shares. However, there has been a tendency in recent years to issue complex financial instruments that technically meet the classification of equity, but are actually in most essential respects debt. Hence, there is a need for an accounting standard in the area to ensure that debt and equity are correctly classified and disclosed. The table below illustrates some of the ways in which gearing can be manipulated. Improving the numerator by reducing debt. Keeping long-term liabilities off the statement of financial position by using an off-statement of financial position scheme or a special purpose entity, SPE. The use of operating leases instead of finance leases. Remember, this is to improve the numerator and keep the gearing ratio down through manipulation. Repackaging debt, disguising it as a form of sale and repurchase agreement. Splitting one overall transaction into a number of smaller transactions. Example, sale and leaseback, debt factoring, consignment stock, in order to show different aspects of the transaction in different accounting periods, thus lessening the impact on the financial statements. And also window dressing, which is improving the appearance of the statement of financial position. Improving the denominator to obviously improve the gearing ratio by increasing shareholders' funds. Revaluation of assets, thus increasing reserves. Revaluation of assets, thus increasing reserves. Including brands and other intangibles in the statement of financial position. Distinguishing debt as equity, disguising debt as equity in the form of redeemable preference shares. Disguising debt as equity in the form of redeemable pref shares. Capitalizing development expenditure rather than writing it off in the income statement. And lastly, showing items net rather than gross by netting off loans against the assets that they finance. Repeat, showing items net rather than gross by netting off loans against the assets that they finance. The effect on the income statement and related ratios may have a bearing on whether an entity seeks to classify financial instruments as debt or equity. The effect on the income statement and related ratios may have a bearing on whether an entity seeks to classify financial instruments as debt or equity. Where an instrument is classified as debt, there are related finance costs, which will be recognized in the pre-tax section of the income statement, and they will consequently affect interest cover adversely. The value of equity. Wherever possible, market values should be used in preference to book values for the capital gearing ratio. Repeat, wherever possible, market values should be used in preference to book values for the capital gearing ratio. When using market values, care must be taken when calculating the market value of equity. When equity is valued using book values, it must include any reserves and retained profits that are attributable to the ordinary shareholders, that is, book value of equity equals ordinary share capital plus reserves. When market values are used, reserves must be excluded since they are considered to already be incorporated in the market price of shares. Repeat, when market values are used, reserves must be excluded since they are considered to already be incorporated into the market price of shares. The market value of equity equals the number of shares multiplied by the share price. Repeat, the market value of equity equals the number of shares plus the share price. Effect of gearing on the equity investor. High gearing exists when an entity has a large proportion of prior charge capital in relation to equity. Low gearing or no gearing may not necessarily be in the equity investor's best interests, because the entity might then be failing to exploit the benefits which borrowing can bring. Provided that the return generated from borrowed funds is greater than the cost of those funds, capital gearing should be increased. The extent to which it is prudent for an entity to increase its capital gearing will depend on many variables, such as the type of industry within which the entity operates, the cost of funds in the market, the availability of investment opportunities, and the extent to which the company can continue to benefit from the tax shield. The ordinary share price of highly geared entities will tend to be depressed in times of rising interest rates.